In recent years, global credit ratings agencies have been key players in determining the cost at which African governments can borrow funds and have come under intense scrutiny from African nations. As these countries strive to fund crucial infrastructure projects, the power wielded by agencies like Moody's and Fitch has become increasingly controversial. Accusations of bias, which may inflate borrowing costs or even shut countries out of international markets, have led to growing calls for a continental alternative. With many African economies heavily reliant on external financing, the stakes couldn't be higher. Global credit ratings are crucial for African nations to access international bond markets, determining the cost of borrowing to fund essential development projects. African countries have accused these agencies of bias, arguing that unfair downgrades increase borrowing costs and hinder their ability to finance infrastructure. In response, there's a growing movement for the establishment of a Pan-African credit ratings agency aiming to offer a fairer assessment of African economies by 2025. Let's go now to Aberdeen in Scotland and speak with Theo Achiumpong, who's an economist and political risk analyst. Welcome to the program, Theo. So explain to us, how do global credit ratings agencies influence the borrowing costs for African nations on international markets?
Good morning, pleasure to be here. Point is that the access to international capital markets has become a major means of financing the budget deficit of many countries in sub-Saharan Africa. And often really is because of the low domestic revenue mobilization, and therefore they need to raise capital to meet the many infrastructure and other commitments. However, as you rightly pointed out, the issue of bias often comes up against the three big ratings agencies, Fitch, Moody, Standard & Poor's, which control almost about 95% of the market. And it comes down to the fact that they are quick to downgrade African countries and then they are slow to upgrade. And in instances where you actually have a downgrade, it means that the cost of capital likely would go up, especially when you look at sub-Saharan Africa, where interest repayments constitutes often the highest and the fastest growing proportion of government expenditure, and sometimes it's actually between 5 to 16% borrowing cost, whereas in Europe and other more developed markets is sometimes even close to zero. And this is really where a lot of African countries complain that the global financial market or the architecture kind of works, against them. And these downgrades especially means that they have to pay more and more in terms of interest payment on the loans that they take, and ends up perpetuating a cycle of future likely default.
And Theo, do you believe those claims among African nations that the three major Western ratings agencies are indeed biased against the continent? Is there evidence to support those claims?
Actually, the evidence is quite mixed. There's quite a number of studies that have come up, two very recent ones from last year, one by the United Nations Development Program that kind of lends or alludes to the fact that there is some bias, and then a recent IMF study that also shows that, in fact, when you actually take into account country-specific factors, such as the credibility of the budget processes, such as how governments borrow and spend in Africa, the idea or the claim of this bias actually vanishes. So you've got quite a mixed evidence based on that. I also quickly want to say that most of the financial institutions that lend to these African countries don't base their lending decisions solely on the credit score or the credit ratings. There are other factors that they take into account. So the credit rating is really one of many other several factors that go into the lending decision.
And what about this idea of a Pan-African credit ratings agency based on the continent? Is that feasible, and do you think that might fix the problem of restricting access to global bond markets?
I think the idea of having a Pan-African ratings agency, I welcome that. And I mean, having more players in that architecture is good in terms from a competition perspective. However, the big really issue here is one of trust and one of credibility, in the sense that no investor is going to take any African ratings agency serious if they are shown to persistently underprice the risk. The business of ratings, it comes down to how you price, risk. And so to the extent that they are able to show that they have the credibility
Yes.
and the trust, and the market goes with them, then that would be welcome. But if it's actually proven to be the other case, then there would be major issues there. And in fact, in
Okay.
recent times, for most of the major ratings agencies, their methodologies are actually published on their website and other portals. So it's not a black box as many claim to be.
Okay, Theo Achiampong, we will have to leave it there, but thanks so much for breaking that down.